Hello everyone. Today we'll be seeing about Dow theory in technical analysis. First, let's see what the Dow theory is and who founded it. Dow theory is a trading approach developed by Charles Dow, who is the same person who also developed and founded the Dow Jones Index. Dow theory is the basis of technical analysis of financial markets. The basic idea of Dow theory is that market price action reflects all available information and the market price movement is comprised of three main trends: primary trend, secondary trend, and minor trend. Now let's look at the six major principles of the Dow theory. The first principle is that the market discounts all news. And the second principle states that the market has three trends, as we have already seen: the primary trend, secondary trend, and minor trend. The major trends have three phases: accumulation phase, public anticipation phase, and the panic phase. The indices confirm each other according to the fourth principle. And the fifth principle says that the volume confirms the trend. And the last principle of Dow theory is that a trend is assumed to be continuous until definite signals of its reversal. Now let's look deeply at the first principle, that the market discounts all news. This principle explains that any information available in the market is already reflected in the price of stocks and indices. This includes all data such as earnings, announcements by companies, rise or fall in inflation, or even sentiments of investors. As a result, it is better to analyze price movements of a stock instead of studying earnings reports or balance sheet of companies. Now, the second principle is that the market has three trends. This theory was the first to propound that the market moves in trends. Now, let's look at these three trends. The first is the primary trend, and it is the major trend for the market. It indicates how the market moves in the long term. A primary trend could span many years. Now, if you look at the image beside, you can see the primary trend in this picture. Now let's look at the second trend. The secondary trend are considered to be corrections to a primary trend. This is likely an opposite movement to the primary trend. For example, if the primary trend is upward or bullish, the secondary trend is downward. These trends could last anywhere between a few weeks to a few months. Again, in the image beside, we have an example of the secondary trend. Now let's look at the last trend, that is the minor trend. Minor trends are fluctuations to the market movement on a daily basis. These trends last for less than 3 weeks and go against the movement of the secondary trend. Here we have an example of the minor trend, and it's marked in red so you can identify it easily. Now let's look at the next principle, that trends have three phases. The theory says that there are three phases to each primary trend: accumulation phase, public participation phase, and panic phase. The beginning of a primary upward or downward trend in a bull or bear market is known as the accumulation phase. Here, the traders enter the market to buy or sell stocks against common market opinions. In the public participation phase, more investors enter the market as business conditions improve and positive sentiments become evident. This results in a higher or lower price in the market. The panic phase is marked by excessive buying or selling by the investors. This could result in great speculation. At this stage, it is ideal for investors to book profits and exit. Now let's look at the next principle, that says indices confirm each other. A trend in the market cannot be verified by a single index. All indices should reflect the same opinion. For example, in case of a bullish trend in India, the Nifty, Sensex, Nifty mid cap, Nifty small cap, and other indices should move in the upward direction. Similarly, for a bearish trend, all indices should move in a downward direction. Now, the next principle is that trends are confirmed by volume. The trend in the market should be supported by trading volumes. For instance, in an upward trend, the volume rises with increase in price and falls with decrease in price. And in a downward trend, the volume increases with a fall in price and decreases with the price rise. Now, the last principle is the trends will continue until definitive signals indicate otherwise. The theory says that the market trends exist despite any noise in the market. That is, during an upward trend, a temporary trend reversal is possible, but the market continues to move in the upward direction. In addition, the status quo remains until a clear reversal happens in the market. Now let's look at some of the criticism of the Dow theory. It is not a trading theory but interpretation of known data. It is also based on historical representation. And the major criticism for Dow theory is that it is fallible as it depends on the interpretative ability of the analyst. Thank you for watching this video. If you would like to create a free Demat account, there is a link in the description. For more videos on stock market and trading, please subscribe to this channel.